Welcome to today's What Will Move the Market show. I'm your host Prem. It's Friday, February 13th, 2026, and here is everything you need to know as the markets open for today. Overnight on Wall Street, it was a rough session for equities as the sell-off in technology and high-growth names deepened. The Dow Jones Industrial Average fell about 1.3% to around 49,452. The S&P 500 dropped roughly 1.6% to about 6,833, and the Nasdaq 100 slid just over 2% to roughly 24,688. The trigger was not one single data point, but a combination of lingering jitters after strong United States macro readings, fading hopes of very early Federal Reserve rate cuts, and fresh worries that aggressive artificial intelligence adoption could disrupt earnings in sectors from software to communication services. Investors are now squarely focused on the next big consumer inflation print, which will heavily influence the Fed narrative over the coming weeks. Under the surface, there was real pain in big tech and old world technology alike, while defensives and energy held up relatively better. Several large cloud, semiconductor, and software names in the S&P and Nasdaq baskets underperformed as traders took profits in the winners of the last few months and rotated towards value and cash-generating stories. In the after-hours session, there were sharp individual moves in select technology and platform companies on earnings and guidance, with some beating expectations on revenue growth but still getting punished on cautious outlooks, a clear sign that the bar for good results has moved much higher. These after-hours moves could keep volatility elevated when the United States market reopens tonight and will be important for Indian IT, semiconductor-linked names, and internet stocks that track global tech sentiment. Turning to Indian ADRs listed overseas, the cues are sharply negative for information technology but more balanced for financials and conglomerates. Infosys ADRs closed at $14.21, down a steep 9.75%, a clear reflection of global nervousness around high-valuation IT services at a time when clients are tightening tech budgets and reassessing large deals. HDFC Bank's ADR ended at $32.86, down about 1.05%, signaling some profit-taking but no signs of panic, while ICICI Bank's ADR actually finished in the green at $31.26, up 0.45%, showing continued confidence in India's private banking story. Reliance's global depository receipt closed at $64.6, down a mild 0.31%, mirroring the healthy but cooling uptrend seen in the domestic stock. Overall, the overseas message for Indian investors is that global money is turning more selective. Export-oriented IT looks vulnerable to further derating in the near term, while high-quality financials and diversified conglomerates continue to command support on dips. Looking across Asia, as of the latest available data, the tone is cautious but not outright bearish. The Nikkei, or Japan 225 index, last traded near 57,129, up about 0.29%, showing that Japanese equities are still finding support from weaker yen expectations and corporate reforms despite global volatility. The Hang Seng, tracked here as the Hong Kong HS50 cash index, was recently at around 26,611, down about 0.29%, reflecting ongoing pressure on Chinese internet and property names. The Shanghai Composite Total Return Index was last around 4,741, up about 0.06%, a very modest move suggesting that mainland investors remain cautious but are not capitulating. These are the latest available levels heading into our recording window. Fresh live trading moves through the day could add to the volatility as Asia digests the United States sell-off and awaits the next set of global macro signals. Closer home, offshore GIFT Nifty futures are pointing to a weak start for Indian equities. The latest GIFT Nifty 50 index futures quote is around 25,721, down roughly 0.5% or about 130 points from the previous Nifty 50 close. If this pricing holds into the opening bell, it suggests a gap-down start for the benchmark index, with IT, high-beta financials, and recent momentum stocks likely to see the most pressure at the open. Traders should be prepared for a choppy first hour as the market tries to find a new equilibrium between global risk-off cues and still healthy domestic fundamentals. On the global macro and commodity front, a few developments matter for Indian sentiment today. In the United States, stronger recent macro data have pushed back expectations of aggressive rate cuts, supporting the dollar and raising the bar for risk assets, which in turn keeps pressure on high-valuation growth stocks worldwide. In commodities, front-month gold contracts in dollar terms are trading around $4,973 per ounce, up about 1.06%, while silver is near $76.66 per ounce, up roughly 1.9%. These bounces come after a period of intense volatility in precious metals and underline that traders are still using gold and silver both as hedges and as short-term trading instruments rather than pure safe havens. Crude oil is relatively stable, with United States WTI Crude hovering near $62.98 a barrel, up a marginal 0.13%, which is broadly manageable for an oil-importing country like India, but still demands monitoring in case of any fresh geopolitical flare-ups. Bringing it back to the Indian market setup, the key theme is that global risk sentiment is wobbly, but domestic macro and policy backdrops remain supportive. The Reserve Bank of India's latest policy decision kept the repo rate unchanged at 5.25%, with a broadly neutral tone, emphasizing that inflation is comfortably within the target band and that growth momentum remains robust. Fresh data under the new CPI base show January retail inflation at about 2.75%, well inside the RBI's tolerance range and giving the central bank room to prioritize stability and growth over any hurried rate cuts. For Indian equities, this means no surprise from the domestic policy side for now. The bigger swing factor today will be how global investors digest the United States tech shakeout and the upcoming United States inflation data. From a technical perspective, even though we do not yet have today's official pre-open quotes, the key levels many traders are watching remain fairly well defined. For the Nifty 50, immediate support sits in the broader 25,700 to 25,750 zone, which has recently acted as a congestion area and where put writers have been active. A decisive break below that pocket on strong volume could open the door toward the more important 25,300 region, which several technical houses highlight as the next major downside test. On the upside, resistance now lies near 25,900 and then around the psychologically important 26,000 mark, where there is likely to be heavy call writing and recent supply. As long as Nifty trades inside this corridor, you should expect choppy, range-bound intraday moves rather than a clean directional trend, with opportunities both long and short for nimble traders who respect their stops. Bank Nifty, meanwhile, is showing relatively better structure compared to the broader market. Immediate support is seen in and around 60,500, with stronger demand expected closer to the 60,450 region, which has acted as a springboard in recent sessions. On the upside, resistance sits between about 60,950 and 61,000, and a sustained move above that band could signal that financials are ready to lead the next leg higher. For now, though, the index appears to be in a consolidation phase after its recent outperformance, so traders may prefer buying quality banking names on dips near support zones while avoiding aggressive chasing on breakouts unless global cues turn clearly supportive. So how should you think about your day plan amid all these cross-currents? With global risk sentiment under pressure due to the tech-led sell-off in the United States, a reassessment of how quickly the Fed can cut rates, and the looming United States inflation data, this is a day to respect your levels and your risk, rather than chase large bets. If the GIF Nifty indication of a soft open plays out, use the first hour to observe whether key support zones on Nifty and Bank Nifty are being defended with genuine cash market buying or just short covering. Avoid the temptation to average into losing positions simply because prices look cheaper compared to yesterday. Focus instead on clearly defined entry and exit points. Given SEBI's tougher F&O regime and the elevated volatility in global cues, traders would do well to size positions modestly, stick to tight and predefined stop losses around the support and resistance levels discussed, and focus on liquid, frontline names rather than illiquid high beta counters. Investors with a longer horizon can use weakness in structurally strong sectors, like high-quality banks, select manufacturing, and domestic consumption plays to gradually build positions. But even there, staggered buying and patience are key in this kind of news-heavy environment. And that's a wrap on this morning's edition of What Will Move the Market. Stay tuned for the evening wrap. Keep sending in your questions and thoughts, and don't forget to subscribe to this podcast so you can join us every trading day as we track what really drives the markets.